Hello, everybody, and welcome. I'm Jeff Finkel, CEO of the Arcview Group, and welcome to our webinar, The Top Red Flags That Derail M&A Deals. So today, Jason, along with Heather, George, and Scott and Jeremy, are going to walk through an overview of basically how to be ready. They're going to cover being ready strategically, operationally, financially, and from a legal and compliance perspective. They're also going to talk about the process and discuss market and buyer dynamics. So most skilled entrepreneurs and operators, unless they've been through it, may not understand all these dynamics. So as we like to do with all of our Arcview Access programming, we'd like to help educate and save you from some of the mistakes we've seen other operators make when going through a transaction. Now, before I begin, for our new viewers, let me introduce you to the Arcview Group. And for the old timers, you're just going to have to sit through it again. So we were founded in 2010 as an investor conference producer serving the cannabis industry. We produced, I think, some 50 investor conferences at which investors could meet emerging cannabis companies. Now, in addition, we now manage a venture fund, the Arcview Collective Fund, and we have a consulting division that provides a variety of services, such as developing SOPs and operating plans for operators, providing business valuations, developing brand expansion plans. We even have a program where we mentor social equity licensees, teaching them some of the important skills, like how to communicate with investors and ultimately how to raise money. And we also have an investor readiness service that helps entrepreneurs message to investors, understand all the investor archetypes based on the type of business and the stage of the business, communicate to their board and shareholders, right, with the right amount of detailed information and metrics. And we also offer M&A transaction support. And we also produce a lot of webinars. I think some 55,000 people have registered for our Arcview webinar since 2020, when we started them during COVID. And I imagine by now we've produced probably over 90 webinars on a variety of subjects. So please feel free, by the way, to visit our replays page at www.arcviewgroup.com, where we have a library of very impactful webinars on many topics with a bunch of industry thought leaders. So please do that when you get a chance. Now, let me introduce you to Jason Malcolm, Managing Principal of Arcview Consulting. Jason?
Thank you for the intro, Jeff. And thank you, everybody, all the participants, for taking your time out of your day today to attend the webinar. Much appreciated on our end. I'd like to start off by introducing you to the panelists for today. So we have, from left to right, as on my camera anyway, we have George Abraham, founder and CEO of Rhodium Strategies. We have Scott Delgado, Managing Director of Beach Hill Partners, Heather Malloy, CEO of Speedwell Partners, and last but not least, we have Jeremy Shaw, partner at Vicente LLP. So welcome all panelists, nice to have you here. For those participating in the webinar, so we do have a list of questions, about 10, 11 questions to go over today. I'm not sure if we're going to get through all of them, just given time constraints. We do have an hour for this webinar. Typically, we do like to keep about 10 to 15 minutes, maybe even a little bit more if we can, just to answer a few questions at the very end. But we'll try our best to get through all of our questions that we have laid out for you today. So as Jeff mentioned, this is preparing your company for M&A success. What we did was we allocated these questions into a number of different categories: strategic readiness, financial and operational readiness, legal and compliance readiness, data room and process management, and market and buyer dynamics. Each allocation or each category has about 2 questions each. So we'll start off with strategic readiness. And for the panelists, what I'm going to do is we have the questions as well as some follow-up questions that are baked in to each one of the questions. I'll ask all in one, just to maybe try to save some time and get a quick response from everybody. So first question, for early and growth stage companies, what are the first signals that they should be preparing for eventual exit? And Jeremy, if you like, we can start off with you for this one.
Sure, yeah. I think my other panelists will have some other answers on the business side. I think from my side as a transactional attorney, the first signal is that you're forming a company in a way. And that doesn't mean you're always focused on the exit, but what I mean is you want to be from the outset structuring your company in a way that you're going to make the exit as easy as possible. So some of that is just good record keeping, right? It's having good records of your information documents, your subscription documents, a good clean cap table, making sure that your governance documents account for a potential exit. So maybe that means including drag along rights in your governance documents, understanding what kind of consents you're going to need internally, things like that. Or from an organizational structure, if you think you may spin off one line of your business, setting that up so that's easy to do. So I think from day one, you can start kind of planning and just making sure you're not setting up roadblocks for yourself in the future.
Great. Thank you, Jeremy. Scott, do you want to jump in on more of the financial and the preparedness of this?
Yeah, absolutely. Appreciate it, Jason, and we're glad to be here. And in my role as an investment banker, leading the Hawkeye Capital Markets team, and we've been advising operators in the space for about 5 years on M&A and strategic transactions, including financing. I think it's very helpful for groups to really have a strong grip of on their financials. Really have a controller that's tightly following the P&L. The first question that gets asked in these situations is, send me a monthly P&L. And so that's something that you want to have ready. You want to have someone kind of consistently scrubbing those numbers. Balance sheets also important to have prepared. Projections are helpful, but really that historical financials, understanding and maybe taking notes along the way if there was an outlier, if there was something, a one-time expense that had kind of come up that's not going to be reoccurring. That's the type of thing you're going to want to remember and have notes around so we can maybe back that out if you're adjusting any pro forma numbers for a buyer. And so that's it's not often that we come across groups that have really sound financials. There's generally not audits in this industry, and nor do there need to be for a smaller company. It's helpful as you get a bit larger, but your controller, whether it's your CFO as well or part-time people, we often find filling those roles, really having a firm grip so it doesn't take a long time if you do start having these M&A conversations to pull that together really quickly. And they're going to want a couple years of historicals as well as you go deeper into these things. So that's something that I really counsel on early, getting your arms around the financials.
Scott, how important is tax returns in this case as well? Is that in line with the annual P&Ls and the historic P&Ls?
Yeah, I think tax returns, it will be part of diligence. You'll need to have those. You should be prepared for a conversation around taxes. If there's tax liabilities, understanding what you paid state, local, federally, those, I think in the early stage of the industry, people spent less time focused there. I think now everybody really recognizes those can be really onerous taxes. If you haven't been paying your taxes, the buyer's usually going to look at that almost, as a liability. The tax authorities are in front of everybody to get paid. And that'll be a conversation and evaluation if you haven't done those. And so if you have been keeping track of those, you'll want to make sure that that's really clear. And so, yes, definitely have a grip on taxes. That's not the first thing you're going to send over as tax returns, but it will come up and be reviewed as part of these processes.
Great. Thank you, Scott. And Heather, do you want to provide some light on this topic as well?
Yeah, sure. So I've run a team that did M&A for a publicly traded company, and I've also recently invested a fund in growth equity over the last 2 years. And I think it's important as a company and as a founder that when you go to raise that initial dollar of capital, you're telling a story. And when you go to exit the company, you're kind of showing the story. And so if you think about what you want to show in terms of how you put your best foot forward, the material that you present and how well you're able to substantiate how your business is doing will build confidence with the people that you're interfacing with. So I think that a big part of whatever materials are there, when you think about starting your business, you should be thinking about the exit And I know that every founder has to talk about it when they're raising capital in that very first meeting for that very first dollar. It's like, when am I getting my money out and how am I getting my money out? And I think the other thing that we spoke about, just that is in terms of signals for readiness, I think it's continuing to stay active in your market, looking at the competitive set, understanding how specifically in cannabis, this product has different use cases, different markets, different distribution networks. And so I think the importance of networking like really shouldn't be underestimated because you don't know which strategic relationship could actually be your exit. And so there have definitely been winners and losers for the past, 10, 15 years. And I think there have been many people that thought they might be acquired, that ended up being the acquirer. And I think it's really important when you think about who or where you want your company to land, doing strategic work to build those network relationships. So if you want to have an exit outside of cannabis, don't just be spending time at cannabis shows, be spending time in that other related industry to be talking to people. So I don't know. I think you should, the signals are kind of from the day you raise your first dollar, you're likely looking to exit at some point.
Great, thank you. And George, I don't want to leave you out, George. So I know I called on everyone else to answer the question. So I would like to start the next question with you, but feel free to opine if you have on the first question.
No, thank you. I think Scott, Heather, and Jeremy did a great job on that. So let's keep going.
Let's keep it going. Okay, sounds great. So number two, and George, I'm going to point to you for the first response. How far in advance should founders realistically start preparing for M&A? And what are some of the consequences companies experience when they wait too long? And the follow-up question to this, guys, is do you have an example of a company that started early and saw that preparation really paid off during diligence?
Thank you, Jason. That's a great question. And just to give a little context on my background, I'm one of the founding partners of a company called Rhodium Analytics, where we do offer a full suite of outsourced financial analytics and bookkeeping support services to entrepreneurial businesses. Our team is out of India. They're all MBAs, CPAs, CFAs. And because they're in India but have a high level of competence, we're able to offer really excellent work product for people, but at a really advantageous fee structure. So what we do is we help companies get ready all the time. And in my career, my experience and my advice to entrepreneurs is always think about if you're really moving into a posture to get ready to sell, you want to be preparing 18 months ahead of time. It's going to take you a while to put all of your financial house in order and pull all the materials together, put your team together that you're going to want to help you get through a process. You're not just going to one day say, all right, let's start a process, and 3 months later be out in the market, and 3 months after that be closed. For example, a lot of entrepreneurial businesses haven't had their books audited or even reviewed. Well, the buyer is almost certainly going to want at least reviewed financials and ideally audited financials. You want to make sure you're on a full accrual basis for your accounting. We've seen plenty of companies that may not have been properly accruing all their entries, and you want to go through that because this is going to come out in diligence. Putting together a great advisory team, that takes a little work. You got to find the right attorney, the right banker, the right accountants, get them engaged, start talking to them, start pre-planning. You need a good business model, the dynamic model you can hand to an acquirer that actually shows them how your business will work. And you got to organize your data room. It doesn't have to be fully stocked with all the schedules, but you should have a good start on that by the time you even have that first meeting with people. So, it could take you 9 months to get ready to even reach out to have that first meeting. And then it's going to take you a little while to get to your closing. So that's why we like to think of 18 months as the ideal metric.
Thank you, George. And Scott, I believe you had an example you wanted to share here as well.
Yeah, in my examples is less maybe because it's cannabis. It's everybody's kind of more making mistakes and learning from them. This isn't necessarily one where they were truly ready. It's kind of the opposite. A transaction we did in 2020 and 2021 in Arizona. It was a strong operator that had been focused on their stores and their operations. When the ballot initiative passed to have adult use occur in Arizona, the acquire started knocking on doors really quickly because they were ready to go. And there was a client that started to have multiple parties, and they were entertaining those conversations, and they weren't ready. And so they had offers on the table, more kind of high level, historical financials were discussed. And when we were contacted, when they realized, boy, we really need help sorting out these offers and trying to get the best one and putting our best foot forward, we were kind of brought in a little bit late. And we had to kind of put those conversations on pause. It was over the holidays, and it was in December. And so, we had a little bit of room around kind of, claiming holidays, but it took us, and we were working really quickly over weekends and over that Christmas break, to help them really get their arms around it. And part of it is making those financials really legible. And sure, they're in spreadsheets, but it's also nice to put them on presentations. In particular, if you can kind of spoon feed your buyers, keeps them really engaged, makes it easier for them to go have internal conversations. And so we help them put their financials onto presentations. They really hadn't focused on projections at all. And with adult use kind of pending and enough buyers around, we really wanted to try to have those buyers focus on the projections as opposed to the historical financials. All the time in this growing industry, you may not have a store that's online, or it was online for 3 months, and you're going to want to get a full year of projections there. And so we were able to kind of keep the parties waiting, as we made the business more exciting, and kept the buyer base engaged. That's also really important. I think we'll probably talk about sometimes momentum, if it slows down, it can kill these transactions. And so you want to keep up the pace of delivering the information that's being requested during diligence. But we were able to kind of pause for a few weeks. And then in that particular instance, with their assets rolling online, with the, conservative assumptions we were able to make about adult use for the coming 12 to 24 months. In that case, we were able to get the purchase price up almost 100% higher than the conversations that they were having, right around November, through December to January. And, we were able to sign definitive documents or document LOI in February. So it came together pretty quickly, but thankfully they got advisors, and we were certainly willing to work our butts off over the holidays to get them. And it turned out to be really good for them because the price went up a lot. So they were really pleased that they had engaged a group to assist them in doing that. And, it's more of they had the foresight. Maybe the timing could have been slightly more dynamic, but we were able to help them get through that situation, even though they weren't ready. But it paid off for them to be ready.
Great. Thank you, Scott. Okay, I'm going to switch into the financial and operational readiness side. So we have a couple of questions here as well. Heather, I'm going to point to you for the first question here. Audited financials are often a gated item. So what is the impact of not having them? And how do buyers view companies that have reviewed or managed prepared statements? And the follow-up question here, Heather, is how do buyers typically adjust? Do they lower the purchase price, add contingencies, or sometimes walk away? Oh, you're on mute, by the way.
Sorry about that.
No worries.
So for when I was sitting in the role on, and leading M&A, many of the companies that we were acquiring did not have audited financials. And so, and I think that's customary. The cost of an audit can be really expensive. So depending on the scale of your business, a full audit may be difficult. It may be too costly. It may not make sense. But what we would do in those cases, and I would expect that in many cases, even if you have audits, this may still occur, but we would work with a group to do a quality of earnings assessment. And so they would look at the existing financials and then make determinations as to where they thought that there were potentially issues that we needed to address. And in going through those quality of earnings issues, what we would end up doing is being in a position of needing to negotiate varied reporting or varied numbers to either substantiate them, haircut them, push them back, or think about whether or not we needed reserves in the business. So for instance, there are certain things like rewards programs that retailers may be using. There's oftentimes issues around the accounting for them, depending on how those are structured. And so there's a number of things in a quality of earnings that a public company or an acquiring company can say, we don't have confidence that this is going to be recurring revenue, or we don't have confidence that this is an inherent asset to the business. And so where that would typically lead me is to either adjusting the purchase price, whereby we would have a direct purchase price adjustment, or there would be a holdback for related to like an indemnification issue. So if the seller wanted to make the argument that this was not going to be an emerging issue, and when we went, through some period of time in the business, that it either was going to be good quality earning, recurring, a good quality asset, or that the liabilities weren't going to emerge, then it would oftentimes end up being maybe a more soft purchase price adjustment, whereby there'd be a period of time that would be agreed between the parties. It was usually 18 months, sometimes as long as 3 to 5 years, where you would look back and potentially have a reserve, and that reserve would then either be released to the buyer or the seller, depending on the way things worked. So not having an audit is not a non-starter, but it will result in more nuanced negotiation, and it will result in having to defend the purchase price and potentially look at adjustments or indemnification holdbacks.
What type of operation or facility would you request an audit to actually occur? Is it something above that's doing 5 million annual a year? Is there a specific threshold to size that you would recommend an audit versus not having an audit?
I think it depends probably on the size of the acquiring company, because you could have two like-sized companies that might be more effectively merging, or one of them may have cash on hand and one may not have cash. And so there might be a strategic reason for a merger that isn't really related to one or an acquisition that may not necessarily relate to a fundamental difference in business value. So I think the quantum is probably difficult, especially when you look at the size of cannabis companies right now is so varied. You have, a handful of behemoths that had audited financials that hasn't honestly mattered. A lot of them are in receivership and working through really complicated issues. And then there's a number of smaller companies that are probably, to George's dismay, running on cash basis, but they're running good businesses and they could merge or acquire a like-sized company. So I think it's I don't know that I have like a standard rule of thumb. Maybe George or Scott has like a stronger view on this.
I'll just throw out really quick. Like, if you, I don't know, $30 to $50 million in revenue, I think that's the kind of thing you should really start thinking about getting an audit at that type of scale.
Thank you.
Yeah, though we have seen quality of earnings analysis come in on companies that are being acquired down to the $10 million in top line revenue. So the thing about an audit is that it forces discipline in your financial systems, and a quality of earnings a team that's brought in to look at quality of earnings, have a very specific mandate to find every problem. And so if you've put yourself through the discipline of getting audited, it's less likely that unusual items will pop up in a Q of E evaluation.
Thank you. Jeremy, I'm going to point to you for the next question, if you don't mind. Beyond financials, what operational red flags and due diligence tend to slow down or derail a deal? And the follow-up question here is, could you give a real-world example of a red flag that seemed small at first, but ended up being a major issue later on?
Yeah, I think, there are a few things that have come up at different stages of the diligence. I mean, the first thing, not so much a diligence item, really a structuring item, is understanding what's allowed in the jurisdiction you're in. So if the parties don't know how to get a deal done in that jurisdiction, or they're not dialed in to what that needs to look like, the parties are going to go down the wrong path, and you're going to have to totally restructure the deal. That's going to cause deal fatigue. That might blow up the entire business reason for the transaction. So understanding that early on your side and what the deal needs to look like is going to head that stuff off. I was recently working on a deal, and the parties, it luckily didn't go too far, but they got it was lengthy LOI negotiations, and they got through it, and then they brought the lawyers in after the fact, and that's not the deal we can do, right? So then we had to start not at square one, but we had to totally redo the deal. You want to make sure your compliance is buttoned up. And if you've had historical compliance issues, you want to have good, clean responses about how that's been dealt with, how you are dealing with it. To a point Heather made earlier about inspiring confidence, like you want to inspire confidence in your buyer that you understand what's going on. People have compliance issues. It's not a deal breaker. But if you look like you're flat-footed on it, don't know how to deal with it, or hasn't been adequately resolved, that's going to cause big concerns, particularly if you're looking at something like a cultivation facility where those issues may have long-term effects on the business. Tax issues, litigation, and really the biggest red flag is bringing that stuff up late in the diligence. You can front this stuff. Again, every business, especially in this industry, like everybody's got skeletons in their closet that have to be dealt with in a transaction. If you're disclosing that after you've gone through a couple rounds of negotiation, that's going to be a problem. So get out in front of it, disclose that stuff early, explain very clearly how you're dealing with it and how the transaction can move forward despite it, and that's going to solve a lot of headaches for you. And I guess the last piece would be any third-party consents, whether that be if there's a lender involved that might need to consent to the transaction, whether it's shareholders, things like that. Again, making sure you have good sight lines on how and when I can get that done, and not bring that up like we've gotten the deal docs done, we're about to sign, but hey, by the way, this is going to be an issue. That's going to throw a real wrench in things and make your buyer really skittish.
Great, thank you. And Scott, did you want to jump in on reverse due diligence here?
Yeah, that's one area that an advisor can really assist on. If you're taking equity in the acquirer, that's an important element. So they've spent their time looking at your business up and down, and if you're taking a chunk of the consideration in equity, you're going to own a piece of their business. And so doing reverse diligence back on them is an important aspect of that. How are they, if they're private, how are they valued themselves? What do their financials look like? And sometimes that conversation, if it's a lot of equity, you're kind of having that up front because that will get into valuation. If we're using this valuation multiple for my business, what are we using for yours? Those type of things, you want to get those discussed, and and if they have a lot of liabilities, you want to understand that too. As if they're, you're merging into something that looks like a sinking ship, you should be aware of that, and that should be something you're definitely considering. If it's a public company, what stock are you getting? Are there going to be restrictions on that, lockups on that? If you think you're going to turn that into cash right away, are you going to be able to? Even as like how liquid is the stock, even when you try to sell it, has been a concern for some of these really micro cap names that we're doing equity deals. So that's some of the areas that we think about with reverse due diligence, which you don't often think about when you're the seller. But in the case of taking equity, it's important too.
And I'd add to that, even if you're not taking equity, if you're doing seller financing, maybe a little bit less due diligence. You don't need to necessarily go into everything, but you need to understand that the party that's going to pay that note has money to do it. You don't want to take that seller financing and the only party that's on the hook is some shell that was set up for this transaction. You want to make sure there's somebody behind it that has assets that you can actually get.
Great. And Heather, do you want to jump in for a last comment on this question?
I feel like we covered a lot. I feel like you should
They
keep
were covered a lot too. I know.
Yeah.
I just have your name down here, so I just want to give you a chance.
No harm.
Okay, great. Okay, moving on, guys, to legal and compliance readiness. Jeremy, I'm going to look at you first here. From a legal perspective, what are the top 3 items that should always be buttoned up before going to market, especially in a highly regulated industry like cannabis? The follow-up question here as well is, do you see differences between tech and cannabis companies? Are cannabis operators held to a higher bar given regulatory scrutiny?
Yeah, I mean, I think some of this reiterates stuff we were talking about before, but understanding deal structure in your market, what's going to be allowed and what the timeline is going to look like. We'll talk about this a little bit later about setting expectations, but that's part of it too, is being able to set expectations with your buyer about what a transaction is going to look like. And then understanding your governance documents. What's it going to take for you to get the deal done? Do you need parties to sign off on this? I mean, unfortunately, a number of deals that are occurring in cannabis right now, they're for distressed companies, and so investors, everybody might not be getting along as they once were. So if you do need people to sign off in a transaction, you want to make sure you're prepared to get those consents, and you have a plan to do that. So I think those are kind of the key points. Planning that period between, sign the deal, you go to get regulatory approval. You're going to have a period of time there. It's kind of obvious stuff, but making sure, like, when does your license expire? Who's going to pay for that renewal during that interim period? What needs to happen with the municipality? Just having good sight lines on that stuff should really be buttoned up, because that's going to dictate a lot of the structure of the transaction.
In many cases, have you seen an owner stay on to be like to act like or the seller to stay on to act as a liaison between the buyer and the municipality to help them move through some of the processes?
Particularly in instances where municipalities are all different. Some are really easy, and some are really particular about who they're working with. So I've had a number of cases where a seller stays on in varying capacities. It may be pretty light, but some kind of transition services that are provided to help transfer those operations over in terms of communications with the municipality, and that can help.
Great. Heather and George, do you want to jump in here as well? I think we covered this topic pretty healthy, but
Yeah, I think maybe George should talk about the tech stuff,
yep.
like
Great. Well,
tech businesses versus cannabis businesses.
Yep.
thank you, Heather. It's interesting, as Jeremy was speaking, I was thinking about this point a lot, and I think there's the notion of tech as maybe being just sort of cool apps or Facebook or whatever, but the tech really is actually oftentimes very highly regulated itself. Like if you think of the whole area of financial technology, that is regulated like crazy, right? And so there is actually, while the regulatory regimes are quite different, the notion of having to deal with pretty heavy regulatory burdens on a transfer of ownership is there in fintech. If you look at med tech or therapeutics or discovery, drug discovery, again, you're dealing with all sorts of interesting regulatory issues over there. And so, there's regulatory issues come up in a lot of M&A. It's not just cannabis. It tends to be just different regimes. And my guess is that particularly if you're in fintech area where you're actually touching people's cash at some point or being a gateway, then some of the regulatory issues are probably somewhat similar and akin to what the cannabis industry is dealing with.
Thank you, George. I think we covered deal fatigue quite a bit over the last couple of questions, so I'm just going to move forward to the deal room and process management. And Scott, I'll start with you here. How do you define a deal-ready data room, and what specific documents or analysis should always be included to avoid frustrating buyers? The follow-up question here is, if you had to prioritize just 5 documents for a small company to prepare first, what would they be?
Oh, well, I mentioned it already, but monthly P&Ls, 2 years worth for sure. It would be great to have a little bit of projections. That's certainly one that you want to be thoughtful around if you do start to talk about projections, because as things play out, we talked about regulatory approval and aspects that will, take these deals months to get done, even quarters. You want to make sure you're going to hit those projections. Nothing aggravates a buyer or gets them skittish if you said you were going to, get X and you come in 10% below X. So be really thoughtful if you are going to hand over projections. We mentioned tax returns, the formation docs came up. I think that's a really important one. If you own real estate, is real estate part of the transaction, or what the lease is, that should be in there as well. You should have, your license information should clearly be in there. Um, Cap table will generally be something that ultimately comes up. People will eventually ask for vendor documentation as well. Um, Balance sheet information on the liabilities back to, does your creditor need to approve something or not? So, having the documents of your capital stack are also important.
Thank you. And Jeremy, is there a legal punch list that someone like yourself or Vicente has readily available for something like this? Oh, you're on mute, by the way.
Thanks. Yeah, I mean, when we're on the buy side, we have a diligence list that we send out, and they can be pretty robust, and I always prefer to kind of go more robust there and let a seller say not applicable. And a seller may use that to sort of, if they haven't gotten a request list, like, okay, what am I going to put together? And I think I agree with Scotty at most of the key items that I want to see there: corporate governance, material contracts, the leases, debt agreements, particularly if they affect the transaction, if there are any kind of employment, like executive employment agreements that might have triggered payments that are going to be implicated in the transaction, and then all your regulatory docs, both at the state and local level. Kind of the key items, along with the financials that should be there.
Great. And if you don't mind, I'm just going to stick with you for the next question. When should companies create a data room? Should they wait until they're ready to sell or during the fundraising process?
Yeah, I think, look, internally, it's good to always be just keeping good records. So it doesn't need to be in a data room, but you should have your stuff as available as you can, or try to, rely on your lawyers. If you do send them your fully executed documents, or if they have them, that's great. In terms of getting the data room set up, you know, the way these transactions start always kind of differs, but what you want to be thinking about is, as soon as you sign an LOI or that NDA to start looking at stuff, you want to turn that data room around like right away. And there's, if you sign that, and then you got to wait a week or 2 weeks to see that, the buyer's gonna say, what's going on here? Are these guys really prepared for this? You're rushing, so you might be missing things that might not be organized. So, as soon as you're engaging professionals to start getting ready for those conversations, that's a good time to get that data room set up, so that you can, right after you get that signed LOI, that signed NDA, you can flip it over to them, and they'll say, wow, great, these guys are prepared, it's organized well, and I can start diving in. And it's good to volley stuff back to the other side too, so that they have some homework, and you can, keep working on what you need to on your end.
I was just going to add something on this. So, as a buyer, when I have the data room, if I come to a selling company with a specific question, I want an answer to the specific question being asked. I don't want to be pointed to the data room. So, I feel like one of the things
Yeah.
that would frustrate me is they'd be like, well, you have the data room. And I'm like, well, there's kind of like, to the point of we were talking about earlier on confidence. Like, if I'm coming to you with a question and it's specific, give me an answer in writing that answers the question specifically, even if the information's in the data room, and then tell me where in the data room to look for the information, but give the answer first. So I think having the data room is critically important, but it's just as important to answer specific questions clearly when you're going through the negotiating process. Because there is usually so much data and so many bodies involved. And so if a decision maker is asking a specific question, I would encourage you to make sure you answer the specific question and then support it with the data room versus just punting to the data room all the time. But maybe that's just maybe that's just an issue for me, but
I completely agree with that. And I think when you're setting up the data room, it's good, on the sell side, have somebody specifically designated to like own that data room and own the responses. Like they're going to be someone who's going to be a point of contact who can respond. Now, maybe they don't have every answer, but like they can be one point of contact for the buyer to get responses that they need. I totally agree. If you're saying, oh, just look what's in the data room, the buyer's going to think you're being either evasive or lazy, and that's not that's not a good posture to be in.
I'll chime in here just to tie a few things together because one thing we were talking about, and it's a little bit of a plug for bringing on advisors, is if you're thinking ahead of time, 18 months or 6 months, whatever that time period is before you want to go to market, and this is where engaging, strong advisors can be helpful. They're going to ask to see the data room right away, and ideally, they're going to help you create the data room. Make sure it's populated correctly, and be reviewing things as they go into the data room to potentially identify what could be these issues that may crop up during the negotiations. We don't want them to crop up too late. So if you have a good advisor, they're almost forecasting ahead. Here's how we're going to have to address the fact that you've got, this weakness, or here's how we're going to have to talk about this lawsuit. Let's put these 3 documents. Let's keep these 8 away for now. There will be a time where we need to talk about this employee lawsuit, if that's what it is, or the way you acquired this asset. It created a lawsuit that is going to come up. Let's give them some information initially on it. They're going to be a separate call. We'll populate it, or we'll give them access to broader set of documents as they dive deeper into the data room. But that's one thing an advisor can be really, really helpful on, is preparing and planning for those expected questions and when to bring them up and how to talk about them.
Yeah, and I think that'll also particularly come up if you're engaging counsel for the first time in anticipation of a transaction versus you're working with an attorney that has been your corporate counsel for years. That attorney knows nothing about your business, and they may know what you've told them, but they have to dive in and see what's there. Otherwise, they're always playing catch up. They're going to end up having awkward conversations with counsel on the other side, not understand it. Hey, I just engaged these guys. I didn't know about this, or I don't have an answer for you. So that data room it's helpful for your professionals too, who may not be familiar with your business. So yeah, it's a good point.
Thank you. Just of the interest of time, I'm going to move forward to market and buy dynamics. I'm going to ask one question in this section and then just a closing wrap up section. So we spoke about deal fatigue quite a bit on this webinar, and there's another question around it, so I'm definitely skipping that. I would like to just ask the following, and George, I'm going to point to you. So deals can fall apart in market conditions, shift mid-process. How can companies maintain momentum? And the follow-up question here is, have you seen a successful company pivot strategy mid-process to preserve leverage, maybe by bringing in a second bidder or changing structure?
That's a great question, Jason. Thank you. So, obviously, you're taking time during a process. It's going on for months and months and months, and things change. That's just the way the world is, and you have to almost expect and plan for changes. Sometimes you don't know what they are, and so regulations can change. More likely, market conditions can change. I remember being on the sell side in 2008 and having a deal ready to close, and then Lehman Brothers announced they were shutting down. Well, needless to say, that deal didn't close the following week, and that was a bad story of having to pivot there. So, but the key thing that I find that really helps keep the deal momentum going is if the entrepreneur makes really smart use of their advisory team. A good banker and a good attorney know when it's time for them to step forward and start being the lead and let the entrepreneur step into the back. It's their job to take some of those arrows and sometimes be the bad person in the transaction and argue with the other side and let you catch your breath. Because the key thing for you as a seller is you need to preserve the relationship with the buyer. You're probably going to have to go work for the buyer at some point. There's certainly going to be a transition afterwards. At some point, you as an advisor, if you're the advisor, you're going to tell the buyer, you know what, we're going to have a meeting where you're going to throw me aside. You're going to say, all right, you and I as principal to principal, let's just cut the deal. And this is oftentimes planned ahead of time. But, to keep these deals moving when there's changing conditions, rely on your advisors. You're paying them good money. They're smart people, and they can help you get through those processes.
Great. Thank you, George. Heather, would you like to jump in here on this question as well? around funding conditions, etc.
Oh, just in terms of when that busts a deal?
The question is, deals can fall apart if market conditions shift mid-process. How can companies maintain momentum?
Well, so yeah, time kills. So you want to try to get your deal done as fast as possible. If anything in your business is changing, you want to be reflecting your forecast because nothing a buyer hates more than a missed forecast, especially if it's in the scope of a deal. And if you think the business is going to do better or worse, it's really important to be able to quantify what the bridge is and know from a management perspective. Do not tell me to look at the model. As a management team, you need to know how you're extracting value and where the growth is coming from because it ties to the actual people. And yeah, I don't know. Time kills and people complicate deals. But at the end of the day, these businesses are generally speaking groups of people. And so the people need to be able to work together. And so I do think like using your advisor is important, but I also think building trust with the between the buyer and seller, especially if they're going to be ongoing key people that keep working in the business. There are, I think, no more difficult conversations that can slow down deals than key person employment contracts or transition services agreements if they're not kind of talked about and worked on. And people can be really critical to deals and the value in those businesses. And sometimes the employees aren't necessarily getting paid to stay on correctly to incentivize them to go to the new company. So I feel like there's been a lot covered here, but long periods of time on deals make things very, very challenging. So I would say try to get, even if it's not a perfect deal, the deal that you can get done faster is sometimes a better deal than the perfect deal that takes 24 months to get done.
Great, thank you. And Scott, you want to mention anything around rescheduling here? Is that something that will fall into play?
Yeah, I mean, look, it's the topic that's come back recently. Thankfully, let's hopefully something gets done. I think a lot of, in some cases, the seller may say, "Well, I was going to go to market, but now that rescheduling is being talked about, I'm going to hold back." Hopefully, they can, and see if something actually plays out. I think from our perspective, sure, some of the public stocks have gone up around this conversation, but last time they gave it all back too, once it didn't happen. And so, you as a seller, you think it's going to increase value. The buyer is going to probably take the opposite point of view and say, "Hey, like rescheduling hasn't happened yet. I'm not going to pay you that multiple." So I kind of caution against when there's news, trying to get value for the news. I think in our industry, there's been so many times the rug's been pulled on stuff we thought was going to happen. And so now I think buyers are really kind of saying, "No, actually, it needs to happen." And in fact, and if it does happen, I'm only going to pay you that value in like an earnout when I actually see it, play in, reduce your taxes or something like that in that case, versus, offering that value up front, not having rescheduling occur and then they're going to take a hit. Given that it's been mentioned that a lot of deals are distressed right now, it's a buyer's market in this industry. And so the buyers are going to kind of set some of the terms around whether they're going to lean in on some of these changes occurring or not.
Thank you. And this is for the wrap-up question. And then we'll open up the line for additional questions from participants. So if you had to give one piece of advice to founders on exit readiness, what would it be? And this is for everyone. So why don't we start with Scott? And I'll just go from left to right on my screen here.
Oh, besides plugging all of us and, is bringing in advisors, which, kind of seems obvious to us. And I think it like a lot of people like think about it, selling your home. It's a real big asset. You're going to do it kind of one time. You generally don't, do it on your own for sale by owner. You use a real estate agent. They're professionals. They understand how to get these things done. They understand the market conditions. They're going to be able to hold your hand through that process because, you've only done, that once. You're going to sell this business, one time. And you need to get every last dollar you can in that transaction. And so, like, don't be short-sighted or pinch pennies, if it's going to cost you a few percentage points on the deal or a retainer fee, but it's going to make up for itself on the price or on the structure. Like, it's well worth it. And so that's, obviously it's tooting our own horn a little bit, but I do think we create a lot of value in these. And It's part of why the larger companies always use advisors. Public companies always use advisors. Just around some of these private companies, people kind of choose not to sometimes.
Great, thank you. And Heather?
Sorry. Well, I think that it's really important to have thought when you go into this process. It's important to have a list of like what happens if the sale doesn't happen and be okay with each of those outcomes, because as you go through the negotiation, you may end up finding that at some point you don't want to do the deal. And it's kind of good to have thought about those possibilities and to do that in an unemotional way if possible. So oftentimes entrepreneurs building these businesses, they feel like they're babies, but at the end of the day, it usually is math. It's a math problem. And if you can separate the people from the issues, I would say make sure you've thought about your list of potential outcomes and where your breakpoints are, and do your best to keep your emotions out of it.
Thank you. Good advice. Jeremy? You're on mute.
Not to reiterate what other folks said. So, I think a successful business is easier to sell. So like number one priority is a solid business that smooths over a lot of problems. So as a business person, like focus on that. And, like Scott said, hire professionals to help with selling it and knowing your business really well. Because that's about inspiring confidence in your buyer. So if you can answer questions well, you can answer them cleanly and clearly about like how oh, why this month was bad because of XYZ. This is why this issue came up. Having a good, confident understanding of that will help your buyer feel confident.
Great. Thank you, Jeremy. And George?
Yeah, thanks. And my advice is more focused on the mental posture that the entrepreneur takes going into a process. In my experience, a lot of entrepreneurs are saying, all right, I'm ready to sell my business, or I want to sell my business. What you really want to say is, I want you to buy my business. I want you to want to buy my business. So if you go into the market saying, I want to sell my business, you're going to approach things very different. You're going to say, oh, look how great my business is. If you say, I want you to want my business, you're going to say, look what my business can do for your business and make your business better. And so I always counsel people, and the approach we take through the process of getting ready is, how are you enhancing their business? And in my experience, you can really boil down the reason that people want to buy a business to two basic reasons. That is one, you're going to enhance an existing business or product line that they already have, and you need to show them how you're going to enhance that. Or two, you're going to allow them to open a new business or open a new product line, right? Everything else falls into that. More revenues, customers, I need better suppliers, distributors, you bring all those things. Those fall into one of those two areas. So your job as a seller is that the story you're telling, the diligence material you're pulling together is telling how you're going to make their business more valuable, and they're going to want to buy you. And if you go into the process with that mindset and you keep that all the time, I think you're going to have a better chance of being successful in your outcome.
Great. Thank you, George. And thank you, all the panelists, for your time today. I'm going to open up the next few minutes for, went a little over, the next few minutes for any questions that participants may have.
I actually have a question or two for the audience that since we're very close on time, Jason, is there any audience member that's raised their hand? If not,
I haven't seen any. No.
okay. I'm gonna throw them both out just in the interest of time. But for those that don't have audited financials, and as you all said, there's very good reasons why an early operating company is not going to pay for an audit unless it's part of their preferred financing docs or mandated by the board. It makes a lot of sense. But for those that don't have it, what kinds of things can they do to be audit ready when they're about to approach a transaction? And as you know, if a buyer insists on audited financials, it's not just 1 year, right? It might be the last 2 or 3 years. Are there anything they can do to be audit ready?
Yeah, I mean, my experience is that you need to be closing out your financials monthly. You need to be doing your financials even if they aren't audited. And then anything that is anything that's creating an asset, a liability, an expense, like you need to have documentation for all of that because and if you're doing a monthly close with your bookkeeper, you'll know what's missing. So, I mean, it's so simple, but like you should be having a monthly close process, and then all of the documentation around that monthly close is just building as a data set. I mean, I don't know what else you guys think.
I want to say, make sure you can reconcile all your different systems to each other on a certain date.
Okay. That,
As
that's helpful. Let me just throw quickly out the second one. In your experience, when is the right time in the process to ask the buyer to evidence proof of funds? We've seen a lot of deals go south where buyers were not in the position to make the purchase.
I'll talk about that one a little bit. I don't think it's the first thing that needs to come out of your mouth. Not that it's unimportant, but you know, it's you know, usually these conversations, it's, you flash, this is kind of what our revenue is, this is kind of what our EBITDA is, or this is what our price expectation is. Um, you get some feedback on that. Okay, this is kind of what we're thinking about value. What are you thinking about structure, right? If there's no cash involved, then you don't necessarily need to, focus on proof of funds. So I think sometimes I've heard people kind of be like, I need proof of funds like a little early. I do think it needs to come up certainly before you sign an LOI. I think if you have advisors, hopefully they know a little bit about that buyer already, and they're giving you some of this insight on their ability to do it. If they need to come up with financing, and that often has been the case, you know, hopefully they'll be upfront about that. I actually need to pull this money together. Then you can have a separate conversation of like, okay, how are you planning on doing that? You talking to your existing investors, or you're already engaged in those processes, or you're trying to do diligence on me and put together some financials and then go out to the market. It is a critical question because it gets into timing, it gets into likeliness of closing the transaction. But I don't think it needs to be the first thing you talk about. But it should come up before you're definitely signing anything. And maybe it's in the second or third conversation. If it's a public company, probably don't need to talk about it too much at all. They know what they're doing in terms of kind of whether they should be engaging in these conversations. But it certainly on private to private. Or if you're talking to the person, they're not really an operator. It's a group of people. I think then it becomes even more important when it's just kind of private individuals and they're putting together their entity already, or in the process of doing it. And you can kind of get a sense of like how premature they almost are, in their buying process. But it's something to look out for. Quite honestly, it was almost a bigger problem with a few years ago with people, just kind of saying they were going to go do these things, and out talking to a lot of parties and people getting excited that they were going to sell, and the buyer didn't really have the wherewithal to do it.
But I also think you can use transactions to give you your comfort too. So either setting up a break fee where if they can't close by a certain period of time, there's a contractual remedy that is to the benefit of the seller because you have an opportunity cost whereby you bound yourself to go forward and they need to make you whole because there were damages done. And then sometimes that will compel somebody to put forward a good faith deposit to minimize any breakage fee. So I think using the terms of, the agreement and just kind of asking open-ended questions like, this sounds great. We want to get comfortable with this. It's a lot of money that we're talking about. So like, how can I get my board comfortable? And I feel like the advisor should be able to help you with that, but it's also a good opportunity. If somebody balks at a break fee or somebody balks at a good faith deposit, those can be red flags too.
Great.
We do have a question here, and well, I'll ask it and then you guys can answer. What EBITDA margins and multiples are you seeing in the current market for the cannabis industry, as well as market discountability are you seeing?
I mean, the EBITDA margins are kind of all over the place depending on the type of business. Retail anywhere from 10 to even above 30%. We've seen really strong retail margins. Typically, the vertical businesses, they can get higher. Cultivation can be higher in the early days. If it's a licensing structure, it's going to be a lot lower. So it really depends on the type of the business. From a multiple perspective, early days, things were talked about with revenue multiples, 1 time, 2 times, 3 times. Like those days are kind of long gone where people are talking about anything above 1 time on a revenue multiple. It's always state specific, it's asset specific, it's what's the dynamics. But, we've seen a lot of things start to really be about EBITDA multiples. You look at the public companies, you can see where they trade. If you're running a private company, like you should have your expectations be below the public guys because you're private. If you're small and in one state, that's another reason. You can kind of talk about reasons to kind of haircut from the publics that, everybody can kind of understand what the public guys trade for. The private valuations are just, whatever people want to say they are. So where are we seeing those as low as 2 times? 2.5, 3, 4 is typically where things are really getting done now. It's if it's above that, sometimes it's buried into a supply agreement or some other kind of element of a structure, or it's just not even being advertised in many cases. And so you don't really know unless you're one of the advisors or one of the parties. And again, that's the reason you want to be around people and advisors that are in these transactions because they have that insight, because it's not always publicly available. In fact, it's rarely publicly available.
But I think all the distress in the market too is weighing on multiples between like distress and then failure, lack of liquidity. So, I mean, honestly, like I'm seeing things coming out at like 1 times EBITDA or less on the distress side. And so that ends up being a competitive benchmark for an active company because I think people are looking at putting together assets that may be underwater due to balance sheet issues, not necessarily operating issues. And so I think that this is a really challenging time with respect to margins and multiples. They are low. So I mean, that's what I would say it is, the multiples are low. That's
Okay, we do have another question, Jeff. Do we have time for another question? I know we're running a little bit over.
Let's just field one more. Maybe have succinct answers and then we'll close off.
Yep. So last one here. Not all auditors are created equal. How do you get comfort with C-team auditors? I've encountered audited financials that didn't add up, basically, is what the question is. So how do you get comfortable with some of your C-team auditors in this case?
I mean, I think it depends if you're using the auditors to check a box because you need to have audited financials, and then you're having a review on with your operating team to understand potentially what's going on in the business. But if somebody's buying a business just based on the audited financials, that's a suspect buyer in my mind. So I completely agree with the person asking the question. There are limitations on the quality of auditors in the space right now. I think it's weakened further over the past like year or so. And so I would hope that if we get any benefit on the regulatory side, that we'll start to see higher quality professional services return to the industry. It's definitely a concern.
Thank you. Jeff, I'm going to pass this over to you. I know we're a few minutes over.
All right. Well, I just want to thank everybody for their insights. I was trying to jot down some highlights to just sort of bring it all together. George, I love that. I want to sell versus I want them to buy. Pretty insightful. Also, the comment about being early with the data room or being ready to sell 18 months. Heather, great quips. Raising, telling a story, exiting, showing the story, and time kills. I love that. Also just in sympathy, I just had a call the other day with somebody, one of our portfolio companies raising a follow-on round. I asked a question. It's in the data room. No. That's too cheap. That's like you do the work. Like, I don't want to answer the question. Let me put it on you. So agreed that's pretty annoying. Scott and Jeremy, great insights on the process and the timeliness of having the data room available. You do not want that gap. So I appreciate all of that. And anyway, again, thank you for your time. The insights are great. Hopefully our audience enjoyed it. Look for announcements about future programming from us. I think the next one we're going to tackle AI and operating businesses. initially exploring the implementation of horizontal solutions, and then a follow-on program about purpose-built solutions for the cannabis industry. So again, thank you for trusting your hour with us, and look forward to seeing you again and giving you some future programs. And again, thanks in advance for filling out that survey. And with that, I think we'll sign off. Thank you, everybody.
Thank you.
Thanks.
Thanks, everyone.
Yeah.